Hi there, I'm Jonathan Dio. I am the founder of Dio Wealth Management, where we work with individuals one-on-one, and the Happiness Dividend blog, where I attempt to educate as wide an audience as possible. I want to talk about volatility and the commentary about volatility that's occurred in the last 3 months. So much of the time, market commentary is focused on figuring out what's going to happen in the next day or week. That is, when it's not focused on what's happening in the current hour. But let's just put this concern to bed. No one has any insight into either what piece of news is going to break next, or into how the market will react to that piece of news. All concerns about current market outlook or current political environment is wasted energy. There's no marker to tell us when markets are going to move up in the immediate, unknowable future, and there is no marker that's going to reliably indicate when it's going to go down. Anyone who suggests that you should either get in now or get out now should be summarily dismissed as a snake oil salesperson. So let's talk about volatility. Yes, it excites us when the moves are positive and makes us nervous when markets go down, even by a little bit, as is evidenced by these last 3 months. We should expect volatility in markets. The absence of volatility is a sign that markets aren't working properly. It's important to remember how well-functioning capital markets work, and that prices reflect the aggregate expectations of all market participants at all times. Risk aversion, investors' tastes and preferences and expectations about future profits are among the many inputs that affect these aggregate expectations. We should expect these inputs to vary from day to day, which implies we should also expect our aggregate expectations to vary from day to day. Markets adapt to changing expectations and new information as it receives it. As a result, we should expect prices as well as the level of volatility to fluctuate. It's interesting to think of the alternative. If prices didn't adjust and remain constant, we would all be looking at the markets as if they weren't functioning right. In January of 2016, the markets opened up the year with the worst starting performance ever. During January, the S&P 500 index had a return of a negative almost 5%, the ninth lowest return for the index in that month since 1926. In fact, the first 2 weeks of January were the worst start to the year for the S&P 500 ever, with the index returning negative 7.93 in the first 2 weeks. At the time, media was stating that we should be wary of a difficult road ahead, largely because of that performance in those first 2 weeks. The blogosphere and the media went into high gear discussing the predictive power of January. Take a look at this chart. Here we can clearly see that the returns of the S&P 500 index for the month of January compared with the subsequent 11-month return, the period between February and December. Now we find that a negative January was followed by a subsequent 11-month return that was positive 59% of the time, with an average return of 7%, indicating a negative January does not predict poor markets for the rest of the year. In fact, if we look at the 5 lowest January returns, excluding January of 2016, the average return for the remainder of the year was 13.8%, and none of those years finished in the lowest 20 years of annual returns. The media was literally manufacturing headlines in order to scare you into paying attention to it. Now, as mentioned above, the year-to-date return for the S&P 500 through January 2016 was negative 4.96, let's call it negative 5%. From the previous high on November 3rd, 2015, through its low on that January 15th, the S&P was down negative 10.5%, its second decline of at least 10% since the beginning of August 2015, which we should probably say is totally normal. On average, we should expect an annual peak-to-trough decline of about 14% every single year. The fact that we haven't seen it for many years allows us to be surprised when we see it. I actually think that this, more than anything else, is probably what's happening today. So let's look more generally at the data to see how the US market has performed in subsequent periods, following different magnitudes of decline. So here we see previous periods when the S&P index has declined by 10 and 20%, and the chart shows the subsequent 1, 3, and 5-year returns. Now, independent of the magnitude of decline, on average, the return of the S&P 500 over the periods referenced has been positive and greater than the long-term average of 10% in half of the time periods we looked at. We also see here the same info for both developed and emerging markets outside the United States, and we come to the similar conclusions about these markets. But the media tells us this time is different. Today's volatility isn't normal, whatever that means. Well, again, let's return and look at the data. For the period January 1926 to December 2015, the S&P 500 had a compound return of 10.02% and a standard deviation, that's a measure of volatility, of almost 19. For the more recent period ending in December 2015, the return for the S&P has been higher at almost 13% with a standard deviation that was lower, 13. Comparing these results with other historical periods, we can see the recent period has not been more volatile. In fact, the data suggests just the opposite. So what's going on? This is catastrophism reporting of the highest order. The media cannot report how incredibly normal current volatility is. They must report something edgy, and they must tell you why it's edgy and what you should do about it, because otherwise you wouldn't continue to watch them or listen to them. The punditry is basically full of it. So what do? Well, I routinely return to a faith in your plan, patience to allow the short-term anomalies to work themselves out, and the discipline to continue the saving investing behaviors called for in your plan. Remember that while in the midst of a market downturn, we are naturally inclined to look for some type of signal as to what the recent period means for future returns, or to assume the current period is somehow different from what we've observed in the past. Media, who are also human and therefore share this natural inclination, but who must report something, pile on to our fears and concerns and may even convince us that this time is different. Before jumping to conclusions or attempting to make predictions about what the future may hold, analyzing the available data can provide perspective. Looking at history provides perspective. There is a natural zig and zag in markets that exist because there are lots of people involved and making decisions every day, and there are many reasons to buy and sell securities. If the volatility didn't exist, there would be no opportunity at all. So learn about personal finance, gird yourself against both the media's cartoonish commentary and your own natural tendency to overreact. Have a plan. Allow your plan, not your emotions, to determine how and when you invest. If you're patient and stick to your plan, this time is different always morphs into this too shall pass. I want to thank you very much for listening. If you think this more philosophical take on markets is valuable, please share this video and check out my other videos on YouTube or at happinessdividend.com. Thank you very much for listening. I wish you way more than luck.